Yes, welcome back everyone. So now we are at reading 24, that is basically about ratio analysis, everyone. So financial analysis process, it begins with analyzing all the financial statement, and there are various things involved in it. So there is a little bit theoretical part here, that what should an analyst do, how should they do the research and all. So there are several questions. What is the objective of doing research? What all informations you need? What all detailed information you need? And then you also have to understand what are the tools available for your research. So the most important tool available for research that we are going to do in this topic is ratio analysis. Ratio, we are going to compare different numericals, different items from the balance sheet, income statement, and cash flows. And to simplify the financial statement between companies to make it comparable, we do common size analysis. Now, the same thing is also done in a mathematical format called regression analysis, more statistical way it is, and in the graphical form. Of course, our focus in this topic is going to be ratio analysis. Okay. So what is ratio analysis? Why do we do that? What are its limitations and all that I will discuss. But before that, let me quickly tell you the other parts, that is graphical and regressional analysis. In graphical and regression analysis, we put all the data in a graph and then compare. So for example, if you see one of the type of graph is what we see pie graphs. Pie graphs are generally used for understanding what are the shares of different things. So for example, if I want to see my revenue, from which location it comes, I can use a pie graph, right? A pie chart, which will tell me which component gives me revenue. For example, if it's Apple, then how much of the revenue comes from AirPods, how much of the revenue comes from MacBook, how much of the revenue comes from iPhone. So I can use a pie graph for that. I can also use a line graph. A line graph is generally done over a period of time to understand the change. But then if I want to do a better analysis, we do a stacked column graph. I've presented here what is a stacked column graph. What are the two things that you notice in this graph? Very important graph this is. In a particular graph, you can actually find two things here. Can you tell me which are the two things visible here? You actually know the benefit of both the pie graph and the line graph. You know also the proportion of each component. See, in one of the stacked graph, if you see in the first year, you know the component of cash, investment, and receivable, right? And over the period, what has been the change also you can see that, correct? So a stacked column graph are used when the composition and the amount, when you want to see the composition and amount, and the change over time. So stacked column graph is a very useful analysis, correct? Regression analysis, it's a more complicated mathematical and statistical way where you try to find the correlation, put that into some equation, and then finally come up with a conclusion that this will be the outcome. Most of the portfolio management techniques of finding expected returns are based on regression analysis. Right? For example, if I want to know what are the factors that are contributing to GDP, and based on the past changes in the factor, I can then predict the GDP in the future. So regression analysis is generally used on the basis of past statistics. Correct? I'm not going into detail about this. You can just simply read over it. Now, after that, the second thing we had in our financial analysis tools, apart from graphical and regression analysis, is what we had common size. We have already discussed about common size, guys, everyone. Common size balance sheet, income statement, correct?
Yes, sir.
But one thing I would like to mention here is the horizontal common size balance sheet. It's an interesting thing. Here, what happens, you take a base year. For example, if I take the base year, all the values in the base year you take as 1. That's the base value, right? And then after that, what happens in the second, third, or fourth year, if they increase, they will increase more than 1. If they decrease, they will decrease less than 1. So you compare everything with the first year. You are comparing everything with the first year. Are you getting it? Correct? So what happens here, each of the item is going to be reflected from the base year. So it is easier for you to understand what happened from the base year, whether the things increased or decreased from the base year over a period of time. So that is a horizontal common size balance sheet. Clear, everyone? So the change, increase or decrease, is adopted by comparing it with one unit. Everyone clear? This is a new thing. That's why I just highlighted it. Okay. And now we will focus on what we have to do is ratio analysis. Guys, have you ever compared ratios? We have done, right? But tell me, you must have done ratio analysis in your graduation course, in your accounting course, and maybe now in CFA also we will do a lot of ratios. First of all, is there a rule for any ratios? Is there a rules prescribed by IFRS or US GAAP for ratios? Let me tell you, there is no authoritative body specifying exact formulas. This is what even the CFA Institute tells, that there is no exact formula for all ratios. There is no common consensus that what should be the ratios. It can differ from analyst to analyst, from company to company, from authorities to authorities, right? So the objective here is not to be precise. The objective here is that present some indication. They want us to provide with the ratios, get into detail of the company and help us understand the project's cash flows, the ability of the company to grow, how well is the management working, how well your assets are being utilized, how efficiently they are utilized, right? Over the period, what has been the change in the profitability? And then you're going to compare this with the past year, time series, and cross-sectional, which is between companies. So that is the objective of ratio, right? So we are not trying to be precise here, but we are trying to be analytical here. However, you need to understand that ratio analysis does come with a lot of limitations. What are the limitations? First of all, you cannot just see one ratio and conclude about the company. You cannot see the ratios in isolation. You have to see them by comparing it with multiple ratios. Only then you can do a judgment. So only because my profit margin is less, I will not conclude, oh, company is doing bad. No, I will see other factors also. Or only because my turnover ratio is better, I cannot say that, wow, the company is doing good. I cannot see a ratio in isolation. I have to see multiple factors. Is that clear? Second, the biggest problem that you face is different accounting treatments, IFRS and US GAAP, because of which the ratio may look different, but they may not actually be different. Is that clear, everyone? Right? So what are the problems? First, you should not view in isolation. Different accounting treatment is a problem. The third, ratios between multiple industries will be different. They may not be the same. So you should be ready to compare relatable companies. So what is good in one, for example, debt equity ratio may be considered as a debt equity ratio of 2 times is considered very risky in a cash rich company, in a cash based business. But a debt equity ratio of 2 times is a very small thing if it's a financial company like a bank or a non-banking financial corporation, a financial institution. In that case, the debt equity ratio of 2 is a very small thing. So you have to relate it with the industry and then make a conclusion, right? And finally, there is no parameter that this should be the ratio. For example, debt equity should be 1 or debt equity should be 5. There is no specific objective. There's no specific target. So it is relied more on individual judgment, and therefore, there is a scope of error or misjudgment also. Clear, everyone? These are the pros and cons of ratio analysis. Everyone clear? So now let's go and do ratio analysis. We are going to do 5 different types of ratio analysis, 5 factors. The first is activity ratios. Activity ratios are also called as turnover ratios. Turnover means, what do you mean by turnover? Turnover, revenue. So in this ratio, your focus will be on revenue. But these ratios are also called, which is not written here, they are also called as efficiency ratios. What are they called as? Efficiency ratio also. So they have activity ratio, turnover ratio, or efficiency ratios. By the name itself, I'm trying to connect that they tell you the efficiency. Efficiency of what? Efficiency of the investment in your company. Where do you invest in your company?
Fixed assets and working
Fixed
capital.
and working capital, right? Those are your total assets, correct? Now listen to this carefully. Let's say there are two companies, A and B. Both companies do a revenue of $100. But the total assets deployed by company A were 50 and company B were 25. Can you tell me which company, according to you, did a better job?
B.
Everyone, come on. Just be a bit loud, Jay. I can't hear you.
B. Company B.
Company B. Why? Because company B invested only 25 total assets and got a revenue of 100. Right? On the other hand, company B had 50 total assets and did a revenue of 100. So can I say company B efficiently utilized its total assets? This is a total asset turnover ratio. What is total asset turnover ratio, guys? It is revenue over total assets. So can I say this is 2 times and this is 4 times? So for every dollar of total asset, how much dollar of revenue did company B do? 4 times. Compared to that, A only did 2 times. Is that clear? This is total asset. Now, if instead of total asset, I replace that with fixed asset or working capital, that will show me the efficiency of fixed capital and working capital. So just instead of total asset, you replace that with fixed asset. It will tell you for every dollar of fixed asset, how much is the revenue you generated. For every dollar of working capital, how much is the revenue you generated. Therefore, higher the ratio, better it is. Is that clear to everyone? Well, I don't think so. It is clear. Is it? Yes, no. Oh, nothing. So let me go ahead. I think it is clear. Or it's not clear. What is it? Everyone?
Yes, sir.
Clear.
Yes, yes. So now, because, why am I pushing forward for this? I could have simply told you that, I'll just read it out and go. But I think the reason I'm taking effort is because I feel that you'll have spent your hard-earned money not only to pass CFA exam, and even if you want to pass, you're not going to memorize all these ratios. So anyways, okay, now comes very important ratio, which the CFA Institute is definitely going to ask. Yes, I'm saying these words because these are the ratios where students end up doing mistakes at times. So now the ratio that I'm going to focus, see, remember one thing in turnover ratios, you have numerator as turnover. Now the ratio that I'm going to focus on is inventory turnover, receivables turnover, and payables turnover. So guys, let me erase this and now put inventory, receivables, and payables. Is inventory measured at the amount of selling price or at cost? Cost. Therefore, instead of having revenue in the numerator, I have cost of goods sold. Correct? But when it comes to receivables, I do have revenue. But which revenue I have? I have credit revenue. Why? Not cash. Because receivables is against the sales that you did on credit. Is that clear to everyone? And payables are for
Credit purchases.
purchases. Correct? So instead of having revenue in the numerator, you have purchases, and generally you have credit purchases. If they don't specify how much is credit and cash, assume everything is on credit. If they don't specify how much is cash or credits, assume everything as
Credit.
Right?
Baki.
Yeah. So in all other ratios in the numerator, you have turnover or revenue. But in these three ratios, since it's inventory, instead of revenue, you have cost of goods sold. For receivables, you have credit revenue. For payables, you have credit purchases. So let me take one of these ratios. Let me take inventory turnover ratio. Inventory turnover ratio. What is inventory turnover ratio now? I will say, instead of revenue, I will say cost of goods sold over average inventory. Average is opening plus closing, beginning plus ending, divide by 2. As of now, ignore beginning or ending, just focus on the ending. So I will just write inventory. Okay. Now again, if I take two companies, A and B, and if I take that data, for example, I take that data as cost of goods sold and inventory amount. Let's say both companies have cost of goods sold of 100. A has inventory, ending inventory. Okay, assume ending inventory of 50 and B has 25. What conclusion does it give me? It tells me the inventory turnover ratio. How quickly have I sold the inventory? A sells compared to the inventory that A has. How much A is able to sell? 2 times, and B is able to sell 4 times.
4 times.
Which company is selling the inventory faster?
B.
B.
So what does inventory turnover ratio tell me? Inventory turnover ratio tells me how fast or how quickly you are able to sell your inventory. Is that clear to everyone?
Yes, sir.
So can you relate that with receivables turnover? Receivables turnover will tell me how quickly you are able to collect money from your receivables. Isn't it? Inventory turnover tells you how quickly you are able to sell your inventory, right? So what will receivable turnover tell me? It will tell me how quickly am I getting my money back from my receivables. Everyone with me on this?
Yes.
So how about payables turnover? What would be payables turnover? What would it signal? Come on, guess it.
How frequently we are paying our.
How quickly or how
Quickly.
fast you are paying back to your creditors, isn't it? To your payables, correct? So can you first tell me, first focus on inventory turnover. Which company is paying your inventory? Which company is able to sell the inventory faster, A or B?
B.
B, right? Now, if I want to convert this into the number of days or months, then there is a ratio to do that. So if I want to see days of inventory in hand, in my hand, how much of the days of inventory is remaining in my hand? How will I do? I will just do 360 or 365 number of days. Let's assume 365 days a year, divide by the inventory turnover ratio. So if you convert the inventory turnover ratio, if you want to convert that into days of inventory in hand, you can do by 365 over the ratio. If it's days, if you want to do it in months, you will do 12 over the turnover ratio. Clear? Everyone?
Yes, sir.
Right? Now, guys, tell me here, if I want to convert into days, what will I do for A? I will do 365 over 2. How much will it be? I can say approximately 183 days. And for B, it will be how much? 92 days, if I'm not wrong, right?
Yes, sir.
365 over 4, 91.5, approximately 92 days, right? So tell me one thing now. Do you want more of the inventory in your hand or less inventory?
Less.
Less.
Yes. Otherwise, your too much of money is blocked, right? So connect it now. Higher inventory turnover ratio will have lower days of inventory in hand. Clear? I'll repeat. Higher inventory turnover ratio means lower inventory in your hand. Good or bad?
Good.
Good.
Right? Efficient. Now connect that with receivables turnover ratio. Higher receivable turnover ratio means how quickly I get my receivables. So do you want it to, your receivables to convert into cash in less number of days or more number of days?
Less.
Less
Less
number of
number of
days.
days, right? So what will happen, guys, if your receivables turnover ratio is higher, your days of sales outstanding means how much of the receivable is yet to collect. You want that less, right? So if your turnover ratio is higher, your days will be low. Good sign? Efficiency? Yes. If your turnover ratio is low, then too much amount of receivables will be pending, which is a bad sign. But now, can you tell that with the payables? If your payables turnover ratio is higher, that means you're paying faster.
Yes.
Yes.
So the number of days of payable will tell me, actually tell me in how many days am I paying back. Now tell me, this is an interesting discussion. Do you want your payables turnover ratio to be high? I mean, do you want the number of days of payables to be more or less? Which means, do you want to pay faster or late?
Late.
Faster.
Faster.
Now, you know what? Why is the difference in answer? Because you are thinking from the company or from the investor. From the investor point of view, do you want your company to delay the payment to the suppliers or pay them on time?
Pay on time.
Pay on time. But if you are thinking like from the company itself, you're not thinking like an analyst. If you're going to think like a company, you are thinking, why should I pay faster? If possible, let me delay. Okay. So that's the dilemma that people have when they look at this ratio. Okay. Now, I will give you an idea. I will give you a question and you have to answer me. If you see that the company's payable turnover ratio is very less, which means that the number of days of payables are high, correct? And now compare that with receivables turnover. So if I tell you that company like Apple or company like Amazon, tell me one thing, and Deepthi can help me here. Deepthi, can you just share us with some information about Amazon? How faster Amazon pays to its vendors or suppliers? Does it pay on the same day?
No, it doesn't happen on the same
Sorry,
day.
Walmart. I'm so sorry. Walmart. It doesn't
No,
pay on
it
the same day.
doesn't. No, it doesn't happen on the same day.
So how much
It
generally, if you can share with us some information that you can, of course, if it's not
takes
confidential.
it takes quite a time, because if we send claims to the vendor,
Mhm.
then it doesn't they have questions too
Okay.
with the returns. So it takes quite a time. It doesn't
Approximately,
happen
can you tell me approximate 1 month, 2 month?
one more than 1 month sometimes.
Okay. So let us take 2 months. So Walmart pays to its suppliers in 2 months. And Walmart, when does it receive from its customer? Immediately, right?
Immediately.
So guys, you have to tell me Walmart's receivable turnover ratio will be higher or lower?
Higher.
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 And payables turnover ratio will be
Higher.
lower.
Lower.
Paying late, isn't it? Relatively. Now, is this a bad sign for Walmart?
No.
No, because Walmart is a dominant company and it can do that. But if you see a company which is having bad profits, it's not having profits, it's having losses. It has already too much of debt on its head. And above all, then you see its payables turnover ratio is also very low. It means too much of days of payables are outstanding. In that case, will you then also conclude that it's a good sign?
No.
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 Therefore, the first limitation I showed you about ratio is that you should not look at ratio in isolation. You have to look at ratio from a broader angle. Okay. So delaying your payments, why is the company delaying? Is it delaying because it can do it? or is it delaying because it cannot afford to pay? That's what you need to analyze. So when a company like Walmart or Amazon or even Apple has higher days of payables outstanding, that's not a bad sign, because I know they deliberately do it so that they earn good money in between. Clear? Correct?
Yes, sir.
So now everyone cleared with days of inventory on hand, days of payables and days of sales outstanding. These are activity ratios. Now, if I want to connect this to an operating cycle, what is operating cycle?
Working capital.
When you prepare the inventory, when you sell your inventory to the customer, and when the customer pays you back, that is your operating cycle. Okay. So if I tell you, you're careful, everyone. If your days of inventory in hand, let's say your days of inventory in hand, it's 50 days. Is 50 days for one of the company. Let's say two companies I have, company A and company B. Days of inventory in hand is 50 days for company A, and for company B it is 60 days. Which company according to you is doing a better job?
A.
A, because it has less number of inventory in hand. Days of sales outstanding, which means how much time does it take for you to collect from your customers? Correct. So days of sales outstanding for company A, let's assume is 40 days, and company B, it is 50 days. So again, A is doing a better job. So can you tell me in how much time company A prepares the inventory and gets the money while selling it? In how many days? That's operating cycle. So what is the operating cycle for A? A
90.
takes around 90 days. You can say that. And B takes around 110 days. Correct? Right?
Yes.
But now an interesting thing. See, now comes the payables. If A pays to its vendors faster, so after adjusting for days of payables, what you get is called as net operating cycle or cash conversion cycle. What is it called as? Net operating or cash conversion cycle. So now what you get in case of A, that 90 days it takes to prepare the inventory, sell it and collect the money. And from that, if I subtract 20 days, so A takes around 70 days to convert the entire cash circle. So it's a cash conversion cycle, which means you prepare the inventory, you sell it, you get money from your customers, and you also pay. So A's cash operating cycle is 70 days. Now for B to match with A, what should B do? Interesting question. For B also to have 70 days only, what should B do?
Pay less. 40 days.
Tell me everyone, should it pay faster or delay?
Delay.
Delay.
Delay. So now if B delays payment to its vendors, then the cash conversion cycle of both is same. Correct? Everyone?
Yes.
Yes.
Got it? So what is cash conversion cycle? When you compare the days of inventory, receivables and payables. So what is the logic that you got from this ratio analysis about managing business? That if your customers are not paying you faster, if your inventory is not getting sold faster, then you pay your suppliers also late. Clear?
Yes, sir.
Okay. So this is cash conversion cycle, everyone. Cash conversion cycle is a part of liquidity ratios. It tells you what is the liquidity with the company, because the company has to convert all this faster, right? The lesser the cash conversion cycle, the better it is. The higher the cash conversion cycle, it means for this much amount of time your money is blocked. And for more amount of time your money is blocked, that's a bad sign. That shows less liquidity. Clear, everyone?
Yes.
The other ratios which we have already covered, current, quick, and cash ratio, which we have already covered in the topic of balance sheet. Current, quick, and cash ratio, in all three of them, you are comparing the current liability, and in the numerator you have current asset. Then from the current asset, if you only take cash, marketable instruments, and receivables, you are making it narrow. So you are making the ratio strict. So from current ratio to quick ratio, it becomes strict. And from quick to cash ratio, it has become more strict because I've taken the most liquid asset, that is only cash. So when I take only cash and marketable securities, that's called a cash ratio. All the ratio, higher the ratio, better it is. Everyone with me?
Yes.
Now comes the most interesting part. Let's say my the cash that I require to manage my business on a daily basis. So I have daily operating expenses. So every day, let's say I have around operating expenses of $100, daily cash operating expenses of $100. And the cash and its marketable security that I have in my company is $10,000. So average daily expenses 100. And how much cash do I have? 10,000. So how many days of expense I can cover is called defense interval ratio. How many days of expenses I can cover is called defense interval. Guys, this should be higher or lower?
Higher.
Higher. What does it signal? It signals that after 100 days, I will have to generate more cash, right? To continuing operations, isn't it? So higher this ratio, the better it is. Clear, everyone? Any doubts, anyone? Liquidity is concerned with short-term survival. Activity is concerned with efficiency. And therefore, solvency is concerned with long-term. Liquidity is concerned with short-term. Solvency is concerned with long-term liquidity, you can say, or long-term, whether you will be able to cover your long-term liabilities and expenses, right? So what are the long-term sources of funds that the company may have to pay in the future? That is debt. So therefore, we calculate ratios related to debt and the interest of it. Okay. So debt ratio, the name itself has the formula debt to asset. It is total of debt divided by total assets. But guys, tell me one thing, total assets, how are total assets? What is the equation of assets?
Fixed assets plus working capital.
Total asset equals to total of liabilities and equities, right? Which is debt plus equity. Remember this. So debt to asset ratio or debt to capital ratio, which shows debt upon debt plus equity. Total capital is debt plus equity. It is almost the same. Okay. You can use either of the ratio. Not a big issue. Then debt to equity ratio just tells you the answer in ratio. So these three ratios, they are just going to give you the same indicator. I've just written it, but they're not going to give you some extravagant information. They are going to give you the same information. They're going to show you how company is leveraged. Higher these ratios means company is highly leveraged. Then you see a financial leverage ratio, which is average of total asset over total equity. So this ratio is total asset is also called as debt plus equity over equity. If you have no debt, this ratio will be equal to 1. And the more and more you have debt, this ratio will turn into the multiplier of 1. So that's why it's called financial leverage. How many times is the leverage? And then you have debt to EBITDA. Debt to EBITDA. So compared to your operating profit, EBITDA is operating profit and you add cash flow. So it's more like an operating cash flow, isn't it? So how much of the debt you have compared to your operating cash flow? Guys, all these ratios, should they be too high or too low? I mean, what is bad? All these ratios, if they are too high, that means company is highly leveraged. Everyone clear with me?
Yes.
Right? So you don't want the company to be highly leveraged. But remember one thing, you will always compare that with the industry and see what is the ratio. So if in my industry, every company has a debt equity ratio of 4 times, but I have 10 times, then that's an issue. But if I have 3 times, then it's not an issue. Correct? Same way you see interest coverage ratio. So you will see, first of all, where do you pay the interest from? EBIT, right? So how much EBIT you have for your interest payment? That is called interest coverage ratios. But like interest is what you have to pay for your borrowings, right? You also have to pay lease rentals for your leases. So they consider lease also as one of the obligations. So fixed charge coverage ratio includes not only interest but lease payments. So I will add back the lease payments to the EBIT and also add back the lease in the denominator. This is called fixed charge coverage. If you have no lease, then fixed charge and interest coverage ratio are same. Clear?
Yes.
Everyone? And one very important thing, when I say total debt in this context, total debt means all the debt, whether short term or long term, not only long term or long term, but all the debt of the company. Is that clear, everyone? Everyone clear with activity ratio, solvency ratio, and liquidity ratio, everyone?
Yes, sir.
Yes.
Now quickly tell me the income statement. Everyone, how do you calculate the income statement? The first thing, revenue minus cost of goods sold. Then you have gross profit, correct?
Profit.
Minus you do operating expenses. Then you have operating profit, which is EBIT, correct? Then you do interest. Then you have earnings before tax. Then you subtract the tax. Then you have
Net income.
net income. From the net income, who do you pay?
Preference dividend.
Preference shareholders. Then what is remaining is called earnings available for equity shareholders, which is net income minus preference dividend. Okay, keep this in mind. Now, which is the first profit? Gross profit. So you have gross profit margin, which is gross profit over revenue. Operating profit, which is operating profit over revenue. Pre-tax, which is earnings before tax over revenue. Net profit over revenue. All the ratio, higher the ratio, better it is. These are profitability ratios with respect to revenue. Now, when it comes to investment, it is interesting. Focus on one thing. Return on total capital. Let's focus on that. Return on total capital. What do I mean by total capital? Can I say total capital means debt plus equity plus preferred all?
Yes.
What is the amount available for all? Which is the profit indicator available for all? Who is paid first?
Debt.
Interest is paid first, right? So what is the amount available for all? From EBIT, everyone is paid, isn't it?
Yes.
So in the numerator, you have EBIT. Denominator, you have total capital. Everyone with me?
Yes, sir.
When it comes to return on equity, in equity, which equity you have? Common and preferred, right? What is the amount available for them? You see this net income. So in the numerator, you have net income, and then denominator, you have equity. Clear?
Yes.
And finally, return on common equity, which is only equity, that is net income minus preference dividend divided by the equity. Everyone clear with this?
Yes, sir.
Also remember, you are comparing an income statement item with a balance sheet item, and therefore this item is averaged. Clear? How about return on assets, total assets? Guys, how do you fund the total assets? Total assets. In this case, the formula is net income over total assets. So how much is the income that you have generated on the total assets? So return on asset is net income over total assets. But if they ask you operating return on asset, if they use this name, then instead of net income, you'll take operating income. What is operating income? EBIT. Clear? So if they say you only return on asset, you will take net income. If they tell you operating return on asset, then you will take operating income. Clear? Everyone? Easy? Now, we will do valuation related ratio. I will go to the DuPont later on because we won't be able to cover in this today's session. So I'll just do the valuation ratio, and the later part we'll be doing in the next section. Valuation ratios. Valuation, there are three types of valuation ratios, which will be very important for equity. This topic and the previous topic where you did FCFF calculation, this is the most important topic for equity valuation. Multiplier, they are multipliers, relative valuation. This helps in relative valuation. So when they say price earnings, you will take price divided by earnings per share. Everything is per share. P to CF, which is price to cash flow, price to revenue, price to book value. So they are going to give you multiplier. So if your price is $100 and if your earning is $10, I will say my P ratio is 10 times for company A. For company B, I will say, let's say price is 200 divided by 10, I will say 20 times. So my conclusion will be company A is valued at 10 times for every dollar of earnings. Company B is valued at 20 times for every dollar of earnings. Is that clear? So I can say company B is relatively more costlier than company A in this case.
Yes.
Now, when I compare instead of earnings, not all companies are profitable, so you may go for cash flow. When you want to go with revenue, you will go for revenue. When you want to see book value, you can compare with the book value. So you can compare with anything that you want. Now, the later part, when it comes to earnings related item, we have already discussed in income statement basic and diluted EPS. And we have also covered the weighted average shares. So I'm not going in detail about that, right? Basic and diluted EPS, we've already covered that in the income statement. Now, what is important after that is the cash flow per share. Well, the name itself says, which cash flow will I consider, guys?
FCFF.
CFO. So CFO divided by weighted average shares. EBITDA per share, which will be EBITDA divided by the weighted average per share. And dividend per share will tell me how much is the dividends declared divided by the weighted average per share. So it will tell me the dividend that every shareholder will get. For every share, how much dividends you will get. Everyone clear? Right?
Yes, sir.
Now, for dividend related, there are few ratios which you have to understand. Dividend payout ratio. Where do you pay the dividends from? You pay the dividends from earnings, everyone. So from the earnings, you pay some part as dividend and the remaining part is what you retain. Everyone with me?
Yes.
So if the earnings are $10 and if you pay the dividend of $4, what is your dividend payout ratio? It is dividend divided by earnings. So I can say my dividend payout ratio is 40% in this case.
Yes, sir.
So how much is the retained?
60%.
60%. So 1 minus payout ratio is called as the retention ratio. Clear? Now, guys, tell me one thing, dividend or retention, who does it belong to?
Equity.
Equity shareholders. So whether dividend or whether distributed or not, this item belongs to the equity shareholders. Now tell me one thing, the company will grow if the money is distributed or retained.
Retail.
Very good. So B here represents retention ratio. So how much, at what rate will the company will grow? That is a factor of retention ratio into ROE. So if I have retained here $6, and how much does the company generate for equity shareholder? Let's say the company generates, if my retention is 60%, and if the company that's my 60% is my retention ratio. And if the company generates return on this amount at 10%, I will say my company will grow at 6%. Okay. So if you want your company to grow at a higher rate, what should you do? Either you pay less dividends or do earn more ROE, or both. Are you with me?
Yes, sir.
What is the highlight of growth rate? If you want your company to grow faster, two things you can do. What?
Increase the ROI or retain.
Increase the ROE or pay less dividends. If you pay less dividend, the retention will be high. Is that clear, everyone? So these are valuation related ratios. Of course, you can do once revision and find it very easy. We've explained everything here logically. So we are covered with activity, liquidity, solvency, and profitability. So if we look at the index, this is one of the easiest topics. We have done the basic discussion here, and in the ratios, we've covered all the ratios except now we are going to do one thing which I forgot to mention here is the DuPont analysis. So after all the ratios, what is important here? DuPont analysis. DuPont analysis. That is one thing which is missing here. So we will cover this DuPont analysis in the next section, and then we will do some small discussion about how this ratio helps us build forecasting for a company valuation or for a credit research. So that's the theoretical part which we will cover in the next topic. Okay. Clear, everyone? That's it from my side today, everyone. If you have any doubts, let me know, or else we'll meet in the next section. Correct? Yeah, please let me know if you have any doubts, or else we'll meet in the next section. Thank you.
Welcome, sir.
Yeah. Bye-bye. See you in the next section. And please do revise. Okay. Thank you. Anyone, any questions? If no questions, thank you. Enjoy your weekend. Yes. Any doubts?
No.
Deep.
Thank you.
Thank you. Thank you. Yes. Deep, Divesh, any doubts? Anything?
Thank you.
Yeah, thank you. See you in the next section. Bye-bye.